Hi, I want to talk to you today about my friends at Bitwise and why they're the best crypto asset manager out there. So many investors I know are working with Bitwise today. They've got more than 20 products to help investors get whatever access they need or want. They've got a team of more than 100 across the US and Europe. They have more than $10 billion in client assets. It's not just the products that show they're all in. They've even supported the ecosystem by donating 10% of their Bitcoin and Ethereum ETF profits to open source developers. And they were the first company to publish their Bitcoin ETF wallet address. Like I said, these guys are true OGs. So please go and check out Bitwise. They really are excellent. Go to bitwiseinvestments.com and see all they've got to offer. That's bitwiseinvestments.com, or just email them at james@bitwiseinvestments.com and let them know that Raoul sent you. Anyway, there are a million ways to access crypto. Explore how you can access it best with Bitwise. And remember, carefully consider the extreme risks associated with crypto before investing. Anyway, thanks very much. Super AI. Everybody wants to know what's going on in AI. This has been the event to figure it out. You get to speak to the smartest people like you trying to figure this out, but also the people on stage. They're the experts. So we get all of that all in one place in Singapore. What more can you ask? It's a brilliant, brilliant event, and you'll come away with lots of new ideas and a better understanding of this incredible exponential world. Hey everyone, sorry to interrupt, but this is the cheesy podcast bit that gets on everyone's nerves, but it's really important to me. Please, if you can like the channel and also subscribe, it helps me a lot to get the best guests in the world for you guys. So click like and subscribe. Appreciate it. Thanks. Hi, I'm Raoul, and welcome to my show, The Journeyman, where we go on that journey to the exploration of the nexus of macro crypto and the exponential age of technology. Today, we bring it all together with somebody that I've known for a long time. I've never actually interviewed, and I've been really looking forward to doing this. Somebody who brings these three themes together and also the investability side. And that's why I want to speak to Tom Lee. Tom has a great history and a great track record in investing in exponential technologies, including crypto, and using a macro framework to understand them. So I thought he'd be a perfect guest for you guys and myself to learn from. So let's sit down with Tom Lee and see what we've got to learn about where this is all going. Join me, Raoul, as I go on a journey of discovery through the macro, crypto, and exponential age landscapes. In The Journeyman, I talk to the smartest people in the world so we can all become smarter together. I always like to give people a bit of your journey. How did you get to where you are today? Where did you start your career? Give us some of the insights of where you came from to today and how you've kind of formed your thinking en route, because we all change how we look at the world as we go on. So I'd love to hear some of that.
I've been interested in stocks my entire life. So as a youngster, I was one of those kids that did like to read the newspaper and check the price tables in the Detroit Free Press.
Hi, Raoul here. Listen, I think we've got until 2030 before the economic singularity arrives. Now, it might not be the exact date, but it's around then. So we have about 6 years to figure out how to unfuck our future. I've put together a report to help you called Prepare for 2030. It's going to help you take the first steps in that journey to make sure you're secure past 2030. So just click on the link below and start your journey now. The Detroit Free Press, that's not the normal place to start.
Yeah. And so after high school, I went to the University of Pennsylvania, Wharton, and studied finance because I was quite interested in business, and ended up in New York. My first job on Wall Street was at Kidder Peabody, which is an old boutique investment bank. At the time, it was owned by GE. I was assigned to focus on the wireless industry, which in the early 90s was in its infancy. I was a very junior analyst, a junior what they call research associate. And the industry only had 34 million cell phones globally at the time.
Wow.
And of course, as you know, it's grown parabolically to almost, actually, I did the last check. There's actually more cell phones today than humans.
Yeah.
So the penetration's over 100%. That was a really helpful industry to do stocks because one, it was an industry that consumed a lot of capital. They were borrowing money. The carriers I covered had to borrow money to build networks, and then until they had enough users on the network, they actually didn't make money, and it was a hyper-competitive business. So I learned a lot about just some of the rules about investing, such as, growth isn't the same as profits because these companies didn't necessarily make money, and yet the stocks actually had value. So it wasn't as if you had to stick with the rules of like earnings is the reason the stock has value, because the carriers themselves had spectrum, which was a hidden asset, and then they had the recurring value of their customers. Subscriber value really was a newer concept in the 90s because besides the cable industry, there really wasn't much in the way of subscription businesses. So the idea of like lifetime revenue per sub, none of these were actually concepts yet. But these were the hidden assets. And one of the things I learned during wireless was really two things that I think were very formative. The simpler realization was that you could really understand what the stocks would do if you followed what the bonds were going to do. So I was at Kidder first, but then I moved to Solomon Smith Barney, and they had a very big high yield trading desk. And that's really where I learned so much about the levels of bonds. And so I knew wireless stocks were in trouble when their bonds were trading below 80. And if their bank debt was below 80, basically, you're going to go bankrupt. But actually, a lot of times the bonds would begin to recover and the stocks wouldn't move because, as you know, equity markets often have their own view about a company's prospects that are separate from the bonds. And so when the bonds recovered and the stocks hadn't, that was always a really big tactical opportunity for us. And so I had made some very famous bottom calls for the wireless stocks because I had seen pronounced recoveries in the bond prices that weren't reflected in the stock prices. But I think the second, maybe more important thing I learned was the bias of age, that I was in my 20s covering wireless. And actually, I became a senior analyst at age 24. So by age 24, I was actually covering my own stocks. And I had a lot of optimism about wireless because I saw how much my friends were using it to communicate. In the 90s, we all had to use payphones and answer machines. But when you had a cell phone, you could suddenly call each other. And so it seemed very revolutionary to me. Whereas a lot of our clients who were in their 40s and 50s thought of wireless as a yuppie toy. And so they viewed wireless as simply something that the landline companies, business wireline or long distance, would use to protect their existing businesses. So they didn't see wireless as actually a replacement or supplanting landline. They saw it as a way to protect landline. And that also gave us a lot of opportunity because, of course, the world flipped. It must have been 2000 or so. The number of cell phones exceeded the number of landlines. So it took, 8 years, but then the crossover happened. And so that made me realize the world of new opportunity and technology cannot be viewed through the eyes of old people, because older Americans tend to favor incumbency. And, of course, that's actually very true to crypto, because I saw a lot of the echoes of crypto in the 2017 period that looked a lot like wireless, the idea of adoption of crypto.
Was it the realization that you had that these things had network effects, that these were kind of Metcalfe's law-based networks? And why was that different to the landline business, which didn't seem to have, or was it still valued in the same way on network effects, or was it more just straightforward cash flows?
Well, the landline business was very mature in the 90s. So penetration was already 100%. And so I think that landline in the burgeoning era, so that would have been the turn of the 1900s, when they were originally laying the cables, was very much a network effects business because that landline business was hyper competitive, because what people were doing in the 1900s was they were laying copper fiber to homes, and they were getting contracts with cities to actually put lines in the cities, on these poles. But believe it or not, they weren't monopoly locations. So there were tons and tons of what they call regional operating companies. And so, many, like even by the 90s, there were still maybe 12 regional telephone companies on top of the bells that were spun out of AT&T, which became a monopoly provider in that early 1900s period. So telephony itself was actually the Wild West in the beginning. And there was this pricing regime called intra-lata calling. So phone calls. So you probably, if you weren't growing up in the States, you won't know this, but like even in the 90s and 80s, if you were calling your friend who lived one lata over, he might only be like literally a 5-minute drive, but he was in what they call a lata area, it was charged as a long distance call. So local phone calls were literally based on a lata, what they call intra-lata calling, and inter-lata was whenever you crossed the lata, which could just be like 10 miles away, or it could be 30 miles away. You don't have any idea. And of course, cellular compressed all that, because cellular suddenly said, like, why should we even charge the difference between local and long distance?
So we're now in the early 2000s. You've seen the explosion of mobiles. You've now seen mobile flip over. What's next for you?
That was a very successful period for us at covering the wireless industry, because it really blossomed from the 90s all the way to the mid 2000s. But by 2007...
Before we do that, we've got the overbuild that happened in the fiber business in 99, 2000. Let's talk a bit about that, because that was obviously a fascinating period that we may or may not be repeating some of the AI stuff right now as well.
Yeah, that was a magical time. You're right. And in fact, it wasn't really, looking back, it started in 96, and it lasted all the way through 2000. So there were 48 months or 4 years where anything related to the growth of internet and mobile, and on top of that, of course, there was the emerging market story, because they were building communications networks globally, meant everything was going to the moon. I remember that period, but it was really an extended period where if you found a stock, and it could be a random name, but it was doing something interesting, it could go up 5 times or 10 times in a few months. And I remember that at the time I was at Smith Barney, our salespeople were getting so accustomed to like stocks having 300% upside that if you had a buy recommendation on a stock that only had 20% upside, they'd be like, come on, Tom, what kind of stock is this? I can make 20% in a week. And I remembered Smith Barney, we'd have this equity capital markets meeting and trading meeting weekly, and we would really talk about market behavior. And Smith Barney was unique because they had a very big retail operation on top of institutional. But every time there was a market drawdown, we would hear from the ECM desk and the trading desks how much retail came in and bought that dip. So it was a market where investors were buying the market steadily, and it, of course, did ascend eventually parabolically. And people were using margin debt very aggressively. I remembered many stories from Smith Barney about people who, instead of getting mortgages, were just taking margin loans to buy a house. And of course, the stock that they owned would go up, so then the house was free. So that did create a really reinforced period that I think resulted in a bubble. And as much as people kind of harken back and say they've seen it again, in the equity world, it has not been as pervasive, and it's been much shorter. And many people have been too quick to call the top. One of the things that happened in that late 90s period, and this, is that it destroyed value investors. Like that was Foster Friess and some other big macro hedge funds.
Tiger, yes. Julian,
yeah,
closed shop.
Yeah, so I don't want to mention Tiger, but yes, like they famously really got steamrolled because that style of investing value was really getting crushed by momentum and the reallocation. It was really boomer capital into the stock market. And then, of course, it ran out of steam. Um, I I think that will happen again. But to me, people who are saying today is a bubble are calling the top so quickly because it was really 4 years. I mean, that's a long time. Like that's someone starting their career and managing director or whatever. You know what I mean? Like it's a long time that this bubble was really being created in the 90s.
And how did you then navigate? So post bubble, we then get the rise of social media and Web 2 essentially, and all of that. How was that lens for you? Were you still looking at that? Where were you? Were you still at Smith Barney or?
I was at JPMorgan at the time. So I joined JPMorgan in 1999, and I was the head of telecom research. I was brought in, and that was the post 2000 period was really interesting and you're hitting on it because the bubble burst, and it was a terrible 2-year drawdown, maybe almost 3 years. But two really interesting things happened. One was value stocks actually ascended. So there was an ascent of a new class of stocks that really did well. But then in the middle of the center of where the bubble burst, okay, where huge deflation took place because all of a sudden fiber prices deflated and service and provisioning prices collapsed, that a new class of tech stocks emerged as winners. And it was the eBays and the Expedias because all of a sudden their business models worked because fiber became cheap. And so you had high gross margin businesses, and actually the winners of the post-internet bubble collapse were internet companies, basically.
And that was because all of the capital costs have been written down to essentially zero for the fiber optic network. So now it wasn't a high cost to run an internet business.
That's right. And I'm sure you remember in that period, because I was still doing telecom, people said there's so much dark fiber, we're never going to use it. They said there's unlimited fiber capacity. So people were just giving it away. And of course, we've used up all the fiber capacity. And actually in wireless had a huge collapse too. But it was a reset of the industry because those stocks ended up, providing and producing huge returns for investors as well.
So that was after the 3G overbuild, I guess.
Yeah.
It was the kind of, well, it wasn't so much of an overbuild as an overcost, because I think it was the UK that first auctioned the
license
it off, and then everybody followed suit in Europe, and it basically bankrupted the whole industry.
Correct. That's right. Yeah, wireless, the US government got pretty wise to trying to monetize spectrum. There were really many famous stories in the 90s because I was covering the carriers where I was sent to an Ohio town. Okay, so I'm working for Solomon Brothers. They're like, can you meet this dentist? And I would go to this town in Ohio, and this dentist in the 90s got a cellular license through lottery. He just applied for it and got it. And he put some towers and was collecting roaming revenues. But he was actually the richest man almost in the entire state, maybe at least in the town, because he was making something like $2 or $3 million a month from a handful of towers. And he wanted to sell it, and these were actually quite valuable. And the carriers would buy them, and of course he was fabulously wealthy with all the cash he had just earned over those years. And so the U.S. realized they don't want to necessarily give these away in lottery, and they began to auction them. And I'm going to get the number wrong, but I think that they've had 36 auctions or something since then. And I keep in touch with some of the people who bought some of the original spectrum. Wireless spectrum actually has been a very profitable strategy. So it's almost like if someone bought in these auctions and held, the annualized return on the subsequent secondary trades has actually been double digits. So, and then there's a very famous sale that was Straight Path. AT&T ended up buying Straight Path. They actually owned a lot of millimeter wave spectrum. and I think it was the original Windstar, but Straight Path emerged, spun out of USLD, and it was like a $3 stock. I remember meeting with them, and this is past the cellular era. This is probably 2018, and it was a $3 stock, but they owned all this millimeter wave, and they talked about how this could be valuable for 5G. AT&T bought that same company for $240 a share. I think maybe like 12 months later. So Spectrum has only gone up in value.
I've got a great story about the 3G license auction in the UK, and one of the greatest hedge fund investors I've ever seen was Lewis Bacon. I don't know if you obviously knew More Capital, right? So Lewis came on to me the moment the auction came out, because it was like a holy shit moment, because I can't remember how much above estimates, but it was wildly above. And he immediately realized that every European government was going to do the same thing, because this was free money, and that the phone companies were already quite a lot in debt anyway, and this was going to become a big issue. And he came on to me when I was at Goldman and said, right, I want to short the telcos. I mean, it was literally within 10 minutes of this. And I said, well, there's no real way of doing it. He said, I want to short the whole sector. So at the time, there was the Dow Jones Euro Stocks telco sector. So I said, okay, let's create a swaps market, which didn't exist. You couldn't trade sectors in Europe. So I had to build the whole sector derivative trading market in Europe based on Lewis Bacon's trade. He sold $500 million in an hour. And it was a fantastic trade because it all collapsed, obviously.
That's almost like the same as tobacco companies having to do a liability burden. Oh,
Yes.
Right?
Yeah. Yeah.
Yeah. Because the carriers, of course, would have future demands for spectrum.
Yeah. So, okay. So now we're in the we've got 2008 to get through as well. So how did you navigate that?
Well, by then, my role had morphed at JPMorgan. So in 2004, JPMorgan asked me to take on a second role there. So I was doing wireless carrier research, but then I also became their head of small and mid-cap strategy. And that was like a bit of a coaching job because they had a lot of young analysts. So I was teaching them stock picking, just because wireless really lent itself to stock picking because the industry grew exponentially, yet the stocks were very cyclical. So it was really a way to, I always had to understand sentiment. But the second reason I think they gave me that job was during the tumult post.com bubble, a lot of wireless carriers were going bankrupt. And I had to work with our DIP lending desk. The DIP lending desk is the desk JPMorgan uses whenever there's distress. And so they provide financing either in a distress moment or when they're bankrupt. And it actually is one of the most profitable businesses because that's really when they have an edge. And some of the carriers like Leap Wireless fell into dip lending trading. And Jerry Madigan was the trader at the time. He was buying the Leap Wireless bonds, and he was buying them at 16 cents. And he started to ask me all these questions about wireless. And we went through, and he realized that the spectrum itself may be money good. So he was able to turn that into a Leap prepackaged reorganization. Leap, he was paid $127 on his 16. So he made the firm several $100 million on a trade that he was just thinking was originally a scalp. And he became a managing director very young. But it inspired me because around that same time, Eddie Lampert was doing stuff with Sears and Kmart. And so I realized that there was a lot to this idea that things that were in bankruptcy might actually have value if you could sort of find the right opportunity. So I asked JPMorgan if I could write a larger piece. And they had just opened this office in Mumbai, which is a research office of really talented Indians out of Mumbai, but they weren't being utilized. And so I had them comb through, I think, like 4,000 bankruptcy filings since the 70s And we put together all this analysis, and then we wrote a report called the Chapter After Chapter 11, which looked at whether or not money was made on stocks that emerged from bankruptcy. And it turns out, like, under the right conditions, I don't remember the report, like we listed 6 things that if they happen, then there's a higher probability that you can actually buy the stock as it emerges, or you could even buy the stock that never got canceled. Like American Airlines was one subsequent example, like where the equity wasn't canceled. And that became a very popular report because it was a way for people to speculate on something that people weren't previously speculating on. So it almost created a
new class.
Yeah, new class. And so that is why they asked me to do small mid-cap research, because this was, there were metals US.
And there was a lot of hedge funds starting in that space as well.
Yes, that's right. And there were like a lot of interesting, like Imperial Sugar, I remembered. And anyway, so I did that for a while. And then in 07, in late 07, they asked me if I wanted to take over the role of head of strategy, because Abhijit Chakraborty, who was the JPMorgan strategist at the time, had moved to Morgan Stanley. And so that's when they asked me to take on the broader macro role. And at the time, I was actually very skeptical, because I was a stock analyst my entire career. So I'm used to going through 10Ks, calling companies, doing road shows, and really thinking of the world as a bottoms up of companies. And then they asked me to do something that's very macro. And I always thought strategists really never knew what they were talking about. So,
and us macro guys never thought you guys did.
Yeah, that's right. And so I said I would do it. And it took me a while to figure it out, because, going from stocks to looking at the market, it's a very different skill set, because there's no edge. At least I felt I had edge when I covered companies, because I could, have my own sources, do my own channel checks. You can't really do that with equities, but I did that, and I would say it wasn't a great experience, because that's really like when the bear market started. But we found our footing, because in 2008 we wrote this report, which was called Guide to Stock Bottoms Part 1. And we still get requests for it these days, because what we did was we looked at every major bear market since 1918 or something. And we had detailed 2 things. One was that almost every major bear market is a retracement of the prior bull market. So it's not about time, it's about how much you unwind of the prior gains. And if we took 1929, the Great Depression, or the 74 bear market, those were 125% retracements of the prior bull. So you have to go unwind the entire gain and then go down even more. But just using those 2 prior bear markets, we said the bottom would be 670 to 720 on the S&P.
It was what, 666 or something?
Yeah, 666. Yeah, and then there's a time, like the bear is a ratio of the prior bull. So the bottom would be, the latest we said would be July 09. So that was our first sort of conclusion. Second conclusion was we listed, and this was kind of just more simple. We took like 7 metrics that you saw before bottom and the order, and it was like things like the ISM and employment. But we basically point out that like employment doesn't recover till after the bear market bottom. So things that happen before a bottom have nothing to do with fundamentals. And so we published that report in 08, but then on like February 20th, the S&P fell below whatever the minimum threshold, like it fell to 710 or something in February or not. So we turned bullish, which was of course too early, because then it went down all the way to 666. But it was close enough to the bottom that that actually really gave us a lot of visibility at JPMorgan, because we were, really one of the first people to actually believe the market had already bottomed in 09. Even as you remember, during the GFC, people thought there was so much ghost inventory that housing wouldn't recover for decades, and we were in a new normal because rates were so low. But actually, we were just arguing that this would look like a typical bull market recovery. And in retrospect, it was.
Yeah, that caught me wildly offside. I mean, I got 2008 really right, 2007 really right. 2009, I just kind of emotionally overrode my business cycle models by thinking there was a further overhang of debt deflation that was going to, and, even though the ISM was picking up, all of the forward-looking indicators were picking up, a lot of people got caught offside because they got so emotionally charged by what just happened.
Correct.
Whether you made money or lost money,
Yeah.
kind of caught people out 2009.
Yeah. I mean, something that I kind of remember that from that period, and I don't know if you can relate, but I was an equity person my entire career. But in 2008, JPMorgan essentially got taken over by the bond side of the business. So, these guys were amazing. I wished I understood what they were saying in 2007, because Eric Beinstein and Pete Occhivetti and Chris Flanagan were all panicked and freaking out in 2007. And so you obviously caught it right. Like, I didn't really know how to interpret what they were saying. But of course, a huge disaster unfolded. But what was interesting is that in 2009, the firm was really controlled by the bond side of the business, which had a very structurally negative view about the prospects for a recovery, which of course was good for the bond side of the business anyways. And so I think that the stock market got taken over by the bond market, basically, or macro, and that made people structurally bearish for much of that recovery because the equity investor got wiped out.
That very episode, and then because most of us have been around for 2001, then missed all of the tech boom that then happened.
Yeah.
Because they kind of couldn't believe it could happen, and it did. And then Amazon was trading at a P of 800, and everyone's like, what the fuck is this? And everybody missed it because everyone's so macro focused and just didn't see it.
Yeah. Yeah, that's right. So, it probably helped that I had a technology background.
Yeah,
and
it did.
Yeah, and I understood the importance of sentiment and how people, when in the equity world, when someone gets tired of an idea, even if they're the smartest person, they'll reach a point that just says, get me out at any price. They don't even care. And they'll never revisit the idea. And, but that's when opportunities created, So, and then around 2014, I was, things were going very well at JPMorgan, and we were in a good bull market, but I was starting to realize that if I stayed at JPMorgan, which is a great place, that was going to be my last job ever, because I was approaching 15 years there. And as much as I think a lot of people would love the idea, I had always followed entrepreneurs and tech people. So I thought I need to think about starting my own company, which is when I left in 2014 to start Fundstrat. But it was based on a small bet, which was that I thought that the non-institutional business would come back. The recovery of equities from 2009 to 2014 was largely institutional trading. There was actually almost a dwindling or an attrition of the retail investor. And, in fact, things like Schwab, they were trading very poorly. And so I thought that the environment would return that was very akin to the 90s. So that's the bet we made when I started Fundstrat, which was really to produce institutional quality research, but try to make it available to a wider audience.
And that's really started playing out by COVID. I mean, we saw a bit of retail participation, but it wasn't really. But then COVID, it was like the entire millennial cohort became financialized overnight. And we'd all kind of given up that the millennials were ever going to be financialized. We thought they're never going to trade stocks. They hate the whole thing. They grew up with Occupy Wall Street. They've had enough. And then overnight, they just turned it on and it never looked back. I mean, it just exploded.
That's right. And, that kind of makes sense because, as we know, post-Great Depression, so let's say you got into the 40s, there were children born during the Great Depression that were becoming adults in their 50s. And they saw how their parents lost everything because of the stock market. So from 1950 to 1960, for instance, using the Fed flow of funds data, net household allocation to equities was negative. People weren't putting new money into stocks. They were taking it out and putting it into bonds. And bonds were actually having rolling negative performance because yields went from roughly, I don't remember, like 3% starting level to almost 7% by the end of the 60s. So they were losing money in their bond portfolio.
And there was yield curve control. So this was financial repression. So they're actually losing money in real terms as well.
That's right. And so, of course, guys like Warren Buffett did famously well, but it shows you like there's a generational scar. And I think that post.com, Gen X was generationally scarred, which is why hedge funds did very well in the 2000s, but retail investors didn't buy stocks. And then, like you're saying, 2020 is when the first millennials were in their 30s. 1980, yeah. So they'd be like in their 30s by that point. And they're the ones that suddenly discovered equities.
And they discovered crypto as well, which was
Yes.
at the same time. So give me your crypto story as well. Where did that come in?
Bitcoin actually had come up in several discussions when I was at JPMorgan. And John Normand, who was the head of FX at the time, had talked about it. He wrote several pieces about. He wrote one that we had a whole conversation around, our firm did, which is that he thought that Bitcoin could become a currency at some point. Now, I think the network value of Bitcoin was like 20 billion, okay? Which made it like a decent sized stock. But he was saying that it was obviously mostly for dark web and, illicit purposes. So I didn't think much of it, and I didn't even follow Bitcoin. But then we started Fundstrat. And then in 2017, I remember just for some reason, I think I saw the price of Bitcoin again. And I was like, whoa, this thing just went 10x in just a few years. And so I've covered stocks enough to know that sometimes when something does a 10x, it means there is something to it, not that it's a bubble. Like most people, I think, tend to think if something's gone up a lot, it's a bubble. But actually, in the equity world, a lot of times it's actually telling you something's real.
Particularly when it's a network. That's the big difference.
Yes.
Networks tend to do this much more consistently.
Correct. So with our not great understanding, we did spend about 4 months doing a research white paper on Bitcoin. It's exactly what you said. First, we found that if you just did a very simple two-factor model, which is the number of wallets and then activity per wallet, it explained over 90% of the rise of Bitcoin since inception.
Yeah, and it's a good approximation for Metcalfe's law. It's the best way I got of fitting Metcalfe's law to the network value.
That's right. And then, we realized that's exactly why social media networks created value. Because, the idea of like eyeballs and someone being the customer and then because it's free and you sell them out, like that was a very new concept. So to me, I had already believed in this idea that you could create businesses digitally that didn't start with a factory. And so we published our first report on Bitcoin. It was around $1,000 though. But we said that by using the same two-factor model by 2022, it could be $25,000. And that was either saying it was going to be worth 10% of gold or the number of wallets were going to increase. I don't remember the whatever assumptions we used. And then when we published at the time, I did it more as like a thought piece. And of course, I was advocating for Bitcoin. We recommended 2%, but it wasn't something that we thought we would hang our reputation on. But it created immediate backlash for us with our institutional client. Who became very angry that we were trying to pitch something that had no tangible value and was clearly just used for buying drugs. So we actually got famously fired by several well-known hedge funds. But then I assumed we were probably onto something because I figured if someone...
Yeah, that's right. When you see that reaction, it's probably right.
Yeah, because if someone hates it, they haven't done the work.
Yeah.
And so now it's almost 9 years later, 8 years later. And Bitcoin's obviously done really well. It's actually had cycles, and you've been involved for a long time too. I remember you told me you got involved like in 2014.
2013, yeah.
2013, yeah.
I wrote the first ever macro strategy piece on Bitcoin in 2013.
Wow. Whatever that was the report John Norman saw. And that,
Might have been,
right?
might have been. 'Cause all the hedge funds, everybody passed it around because it became this thing of like, so I onboarded everybody from Dan Tapiero to Mark Yusko to, I mean, you name it, all the macro people was all because of me. John Burbank, I mean, you name it.
I might say that might have been your report, because I don't know why John Norman would have brought up Bitcoin unless it was spinning around his desk,
Maybe it was. So I know we've got a hard stop coming up. So I just want to cover where we are today. So what's your framework for understanding the year ahead, next year? Just give me your data dump of, what are you looking at? What's interesting for you? How the macro plays out or the markets play.
I think the story arcs are pretty bullish right now. From the shorter lens, this incoming administration, I think, is doing things that look very disruptive at the moment, but I think structurally are really positive, because it's a path for U.S. deficit to normalize. And I think, indeed, I think animal spirits are coming back, even though things like these consumer confidence reports don't show it. And we know that there is tangible drivers of productivity, including AI, in front of us, that justify, investors allocating capital. And of course, there's still plenty of disruption ahead, including crypto. I think Bitcoin is still our favorite idea for this year. So we think it'll be the best performing asset class, even better than gold. But I think anchoring all of this is a demographic story. I can send you some charts later, but if we look at the number of people aged 30 to 50 in the US, that's actually been steadily rising since 2009. It actually went positive in 2016. And what I mean by that is the number of people aged 30 to 50 matters in an economy, because they're the ones that are driving both credit consumption, but also productivity, innovation. Yeah.
And investment. In the end, I think all of macro is just demographics. By the time, if you do enough work, go deep enough down the rabbit hole, the one monster factor of all is basically demographics.
And then there's a contrast, because, as you know, in the rest of the world actually has a depletion of population. And so that's creating the demand for AI workers, which is what the US tech companies are producing. So I think that this does feel like it's going to be a very bullish equity cycle ahead. And that's why we're constructive. And it's been a rough start for this year, but I think we're just sort of getting through some of the kinks and burning off some of the recent bullishness.
Yeah, I'm the same. We get the optimism about Trump, then we get the correction until we get the actual news story. How are you thinking through? I mean, you and I are obviously thinking through the AI in the same way. We're about to produce infinite workers. AI and robots is infinite human intelligence and infinite humans, right? I mean, this completely breaks the economic model. We have no understanding what this is going to do. But let's assume we'll get there whenever that happens. You're starting to even hear Satya Nadella start thinking, and this might be, I want to go back to the psychology of 2000 that many of these people worry about, is they're worrying about, have we overbuilt? Or are we overbuilding data? Are we overbuilding chips? Are we overbuilding? I'm not sure that we're not still underbuilding, but we might be scarred. And I haven't decided, but where do you think we lie on this? Is this an overbuild and everyone's going to write off a whole bunch of capital, or is this still too early to say?
People who are going to call the top in data center demand have never really experienced industrial cycles, right? Because the cycles actually are going to extend until return on invested capital is well past negative. And I would be very surprised if we're already reaching that saturation now, because we know that any model today would have improved capabilities if you improved computing power or capacity. So we aren't even experiencing the negative side of that utility yet. So I think that it actually would still argue that you need to be investing more capital. And I know, like when you look at percentage of GDP, I mean, look at what happened with China when direct private investment, it got to 40% of GDP. And that lasted years before you had overcapacity in China. So I don't know how we're even at saturation today in AI, but that's just in broad strokes. But so I agree with you. I think there's still a big runway ahead.
And here's something I saw somebody make a comment about this, and I thought it was interesting. A good one to talk to you about is we're now starting to see the Mag 7 actually doing capital investment, right? Which they've never done.
Yeah.
They just bought their own shares back. Is that a net negative or positive in their performance? Economic performance is probably good because capital investment was something we'd been missing for 2 decades. But no share buybacks or less share buybacks? Or does it still generate even more free cash flow that they end up just doing both?
Yeah. Well, I think it's highlighting two trends. One is they didn't do CapEx, but they did R&D, which until recently was a P&L expense, not a capitalized expense. And so they're supplanting those dollars for capital dollars that become balance sheet assets. In a world of labor shortage, that means you have less OpEx because that's wages, but you'll have more balance sheet intensity because now you have a computer that you're operating. So I think in a world of labor shortage, balance sheet intensity will go up. So it makes sense that these companies are big spenders of CapEx now. But that does create another wave of innovation because cooling and power supply and uninterrupted power and all these become strategic advantages, which will create another wave of technology innovation. So I think that there's a lot of opportunity and waves of opportunity being created because of that change that you've just highlighted.
Yeah, I think you're right, because it's going to be a game of efficiencies because the cost of these models is going down fast, and the compute is going down, but therefore they can increase output. So it's just this tremendous race to get more efficient at every single component part of that flywheel, from energy to chips to compute.
Yes. And we've even seen it in the financial industry. The financial industry used to trade labor intensive, so had a lot of traders and people. And then they replaced all the traders with computers. But someone naively might have said, well, then financial companies' CapEx will go down because they already have computers trading for them. No, CapEx intensity and tech intensity of the banks has actually only gone up since then. So that arms race, without even AI, is consuming more dollars. And that's, of course, I think going to be the case with AI itself.
Putting your stock picking hat on, how do you pick through what is going to win in the next few years? Because, yeah, sure, we can, sure, Microsoft will do fine, et cetera, but how do we make money out of this? And it's not very clear yet with AI, outside of NVIDIA and a few other stocks, how to really make money out of this, out of robotics. A lot of these kind of exponential age technologies, pretty tricky because not much around. There's pretty slim pickings because there's been no IPO market for bloody forever.
I've got two simple analogies to share that I think we should be looking for in AI. So we just published a study looking at the wireless fiber boom and when the stocks peaked relative to capital spending. And many people, so let's say it was a 20-year CapEx cycle for fiber and wireless. The stocks relative to the broad market peaked 8 years into the cycle. So in other words, like halfway into the cycle, the market will suddenly say enough capital has flowed into the space that they're market performers. However, in that now in retrospect, the 25-year look back, one industry in wireless pulled away from everything. Two did. The first one is the tower industry. It has produced better returns than handset, chips, carriers, spectrum owners, the towers, and it's, as you know, it's a boring business that grows in a unit with demand. The second, of course, was Apple came along, but in 2007, so 13 years into the industry and after the industry's stocks all peaked, Apple came in and essentially gobbled up the economics of the ecosystem. So I think that in AI, it'll pay to look for the tower equivalent and the next iOS that'll come out on top of everything. But I think the second thing that's going to be important is that you just described it. AI is infinite workers with PhD qualifications.
Today. Don't forget, in 2 years' time.
Yeah, it'll be super intelligent, right?
Super intelligence. Something we've never had before.
Correct. And yet, these super intelligent entities have to eat pizza. And what I mean by that is like the best performing stock in the last 25 years is Domino's Pizza because everybody has to eat. So if you could find the pizza of the AI worker, so that's not the infrastructure, it's what you have to feed the worker, that's another moneymaker. And I don't know what that is going to be.
So I've got two thoughts on that. Obviously, one is the energy flywheel, right? If you're feeding AI, it's going to be probably something to do with the energy mix and how that's delivered and what. And I don't know, again, because the energy grid is going to get reconstructed and changed anyway. The other one that I've come up with is we are so digital now. We're going to become more digital. Our roles in whatever a workforce is or the economy is going to change. But tomorrow will be more digital than today. That is a fact, and that is not going to stop for the rest of our lifetimes. So it's going to cause an equal and opposite reaction. Somewhere within this, tangible experiences become premium experiences. And, if you look at the rise of LVMH, there's something in that story which is equivalent to your pizza, but the luxury pizza. Somewhere within this is going to be an equal and opposite story that's going to be immensely valuable to us as humans.
The thing that is the most non-fungible,
That's
like
right. That's exactly right.
Yeah, that's a good point because you're right. We're going to be polluting and corroding so many human experiences, especially like with android robots and fake friendships and things that get really polluted.
Well, look, Tom, we do this now. We're so used to doing this on Zoom. Go back 10 years, you and I would have had to have met at an event or whatever.
Yeah.
And those experiences matter because they actually form true relationships and stuff, and you don't do it this way otherwise.
Yeah, in fact, I don't know if you know this. Someone did an experiment, and you should just check this out. Whenever people shake hands, okay, and the research study this, you 100% of the time end up smelling your hands because you're trying to detect the
pheromones
of someone else, but you don't realize you're doing it. And they said that so it's still instinctual that we need to meet in person.
Yeah, because pheromone exchange is what we do, and we don't realize it because we see dogs do that and cats do that. We don't realize that we do.
Yeah,
but we do. Tom, I know you need to get out of here, but listen, fabulous conversation. I think there's a lot more we can talk about because we didn't really cover much of the future and where it's going. But I just think it's also very important to hear the past because people don't know why you make decisions that you make or why you have the understanding that you have until they understand where you came from. So thank you for sharing that as well. And I look forward to getting together again at some point soon.
Yeah, that'd be great. And probably in person next time, right?
Absolutely, my friend.
Okay.
Take care.
Take care. Bye.
It's always great to get somebody else's perspective on how to think this through. It's interesting that, a lot of people use Tom for like, where do you think the S&P is going with the next 3 months? But I was more interested in the bigger picture and how to think this all through. And I think it's fascinating. I'll definitely get Tom back to talk more about this stuff in due course and to find the investability side of it. Because in the end, we all want to make money out of our own disruption. And that's a key part of how to unfuck your future over the coming 5 years or so before we get to this economic singularity when nothing makes sense anymore. So it's really important to focus on this stuff, learn from the best in the business, and hopefully I'll bring you something amazing next time too. See you then. Super AI. Everybody wants to know what's going on in AI. This has been the event to figure it out. You get to speak to the smartest people like you trying to figure this out, but also the people on stage. They're the experts. So we get all of that all in one place in Singapore. What more can you ask? It's a brilliant, brilliant event, and you'll come away with lots of new ideas and a better understanding of this incredible exponential world. Hey, thanks for sticking around to the end. Look, if you enjoyed it, hit the subscribe button and check out the video here on the right-hand side. I'm sure you'll enjoy that one as well. And if you're ready for more, go to realvision.com/join. I'll see you there.